All right. Let's get a sound check. See if you guys can see the screen and can hear me. I've got the record button going, so we kind of get all this stuff out of the way, make sure everything's working. Normally, I wouldn't be too concerned, but yesterday when I tried to stream in the afternoon, it didn't work. So I wanted to just make sure we had that stuff out of the way. The PDF document that I shared, it's not done. I'm sure it's going to be remade a couple of times. I know that's going to be confusing for people. If you've already downloaded the old one, just throw it away. This one has everything that the other one did. It just has a little bit more. If I come out with new ones, I'll try to make the same disclaimer so you'll know that it's different from the old one. Be a little confusing, I know, but so along the way, uh, in my own journey of learning how to trade options, I had a couple of different resources that I went to. One of them was Tasty Trades or Tasty Works from Tom Sosnoff. He is the guy that created Thinkorswim. He's the guy that created Tasty Works, Tasty Trades, Doe. It's because of that guy that we have weekly options. It's because of that guy that we have smalls and that we have micro options. So the guy is an icon in the industry. And it's because of a lot of the research they did in the last 20 years that we use the language that we all use now in the options market, like rank and implied volatility, crush, and just using the Greeks the way that we do really came from that guy. So that's absolutely amazing, but it's also a great resource because they have a ton of content all over YouTube. If you watch his videos and you're thinking, I have no idea what the hell this guy is talking about, then you know that you got a good place to start. Because everything he talks about at some point will become something that you're going to need. And even though he talks fast and he often talks about things that might seem over your head at the time, uh, digging into the archives of Tasty Trades or Tasty Works and looking through their research will help you. Unfortunately, though, from a new trader perspective, a lot of the stuff they talk about is going to be over your head because I don't think they really did a good job doing introduction. I don't think a lot of places did a good job doing introduction, which is how I wound up finally having to do my own. I had a lot of people along the way ask if I would do something like this. And my answer was always the same. Why would I want to make introductory content when there are 1,000 different books and videos and resources out there that introduce options? Having said that, most of that material seems to have been written by bankers, insurance agents, people that grew up in the options world. They talk like a banker, they talk like insurance traders, they talk like options traders. And that was really confusing for me when I started. So I thought, well, maybe if I translate things into plain English in an introductory video series, stop along the way and ask questions, then maybe we could get you guys to the right spot without having you feel like you have to have a master's in math to be able to trade options. You don't. It does help if you have some experience in math, and learning math is free. So I highly recommend it. There was this great analogy that I heard a couple of years ago. Um, the guy said, our school systems are broken. They're not designed to teach you how to be a master at something. They're just designed to make sure you know enough to pass a grade. So you learned how to add, you learned how to subtract, divide, maybe you got into decimals, but as soon as it got past that, things started to come apart. And I've had a lot of people tell me, well, I'm not good at division or fractions or algebra or whatever, because they never mastered everything along the way. They had a passing grade in addition and subtraction. They had a passing grade in multiplication and division. And then it got to a point where passing wasn't good enough. and then they just fell behind. So if you think, well, I suck at math, no, you don't. You more than likely weren't taught how to do math. So, you just never learned. And if you was to go back, as humiliating as it may feel, if you was to go back and start with division and multiplication and fractions and decimals and go from there, moving up, you will find as an adult that it's not hard and it's not complicated, and you will understand options a lot better because it deals with percentages a lot. It gets into statistical mathematics, which you don't need, but if you understood it, you would be better off. So let's go ahead and get started in the introduction. This is cobbled a little bit from resources that I've gathered along the way. I did write it, but you might find a cut and pasted word now and then, or a sentence. Why were futures even invented, or why were options invented? And it came from the futures market. Up until the 1970s, you couldn't trade options, really. They existed, but it was a disorganized mess, and it was really between two groups of people who wanted to trade something, and they would write a contract. But what everybody wanted was to trade stock the way that we trade futures. And if you're not a futures trader, we trade the forward future price of where we think the market will be eventually. If you leave the market out of it and you just think about corn or wheat, lean hogs, we can bet on what the price of corn will be in the future. And if it's a great year, maybe corn won't be very expensive, right? Because there'll be a lot of it. But if it's a bad year, maybe the price of corn will be very expensive, right? So we can gamble or bet or hedge on what the price of something will be in the future. But we couldn't do that with stock until we got options. So they mimicked the futures market when it comes to contracts, and some of the language that you will see in options, it's based on the futures market, because the futures market has been around for a long, long time. And when they were making the options market, they really didn't know what that was going to look like at first. And a little tip, they still don't know what things are going to look like. The constant change in the options market is very subtle. And even just this month, we've had changes, drastic, really, really big changes that you might not have even noticed, like the Qs having 3 expirations in a week. That's new. And it might have snuck right past you and you didn't even notice. All right, so there's constant change going on in the options market, making it different. So options are used to lock in the forward future price of something. And a lot of new traders come from the logic of social media. 2 people bragging about buying a call and making a 5,000% profit on it. And that's what a new trader thinks that options are. See, let me catch this question here. Let's see. Nope. That is a question about the XLE. All right. So back in the days, guys, think about the way it used to be. Calls came out in the 70s, in the early 70s. Most people didn't have a computer. You had to call your broker. You had to tell them what it is that you wanted to buy. And most things didn't even have options. So The spies did maybe a few other products, but they weren't very liquid. Most people didn't understand them. They didn't know what they were. They didn't know how to use them. So back then you had to call up, you had to let them know what was going on. And now things are completely and absolutely totally different than the way that they were. And that still applies today. If you lose internet, if your computer gets fried or whatever, and you need to close a trade, you need to be able to call somebody. And I've heard everybody say, well, I've got my phone, I can do this, I can always get on the internet, I can always. Don't think you can always do anything. I live in Kansas, we get tornadoes. If things were to go completely to hell, I need to know that I've got backup, and that backup might just be a hotel room for a couple of days. It might be, uh, swapping over to a different device, but it might be me calling the broker and telling them I need to close some stuff down. So make sure you always have some kind of contact numbers. It doesn't cost you anything to take 5 minutes and go look around, reach out before you ever need it and get a contact name. And even if it's just customer support, get a number, know your account number, know what you're in. It will help. All right, Adam, you've been asking the same question all day on both of those trades. The answer hasn't changed. A very, very short term trade that I take for Friday is just that. It's very small. I built it 50 cents wide. Win, lose, or draw, I don't care. I'm never looking back at that trade until Friday. It's a trade that's short. I expect the market to go down. I'm not going to close it until Friday afternoon. Win, lose, draw, I don't care. It's a Friday trade. It has a break even. It's short. I don't care what it does from there. And I have no idea what Tim is doing because I don't follow Tim. I don't follow Tim. I don't follow Dan. I don't follow Creed. I don't follow Rose. I don't know what they're doing. I don't know when they did it. I don't track their trades. I have no idea. I don't hear their live streams. I don't have no idea. I know what I did, and that was to put on a short trade. And the answer that I gave you earlier is still the answer that I'm going to give you now. These are very short-term trades for Friday with a known break even, and I built them very, very small. If they win, I will make money. If they don't, I will lose that money. I'm not going to fix it. I'm not going to roll it, hedge it, try to close it early. I'm going to hold it until Friday, and then I'm going to close it. All right? Very cut and dry. And that's what they're supposed to be. It shouldn't be ambiguity and confusion and doubt and hesitation. It should be very cut and dry for you, for me, for all of us. When you go to get into a trade, you shouldn't have this lingering question of, gee, I wonder where I'm going to get out of this thing. You should know that before you even get in. All right. Now, in a longer term swing trade, we try to put target numbers on there. Like, I'm going to try to get out at 50%. I'm going to try to get out at this price. And that helps. But everybody here does trades differently. And you're new to the community, and I haven't done a lot of afternoon trade talks. So you might not have caught this along the way, but I rarely take very short term trades. Usually I take a day trade or I take a good 30 to 45 day swing trade. And I normally put targets into the post so that you know what we're aiming for. These are very different trades, and they're reacting to the right now immediate environment, which is why I only did them for Friday. And you wouldn't know because you're new. You haven't been here while we did those before. So I get it. No worries. And you wouldn't know unless you ask. So you asked, and now we got it covered, and everything's good. Right? But the answer is still the same answer, though. It hasn't changed. Oh, well, welcome back. And hopefully you were MIA because you were sitting on a beach somewhere drinking really, really great coffee or bourbon or coffee with bourbon. All right. So was there any questions on this page before we go to the next page? Now, the idea of how they were traded back in the days, it's still very popular. A lot of people still trade them that way, but new traders don't seem to see them this way. They all seem to see an option as some sort of widget, which is why we're starting with this. Because, for an example, if you open up an account at TD Ameritrade and you're new and you tell them that you want to learn options, they're going to approach you as if you already owned enough stock that you want to write options against it. As if that would make any sense to you whatsoever. That's how they approach you. Like, oh, sure, you want to trade options? What would you like to sell options against? That's like the very first thing they start with. And for new traders that come into the options market, most of them just see options being traded like some sort of widget baseball card. I'm going to buy a call and later on I'm going to sell that call, and I have no intentions of holding the call. And so they don't even think about selling options. They just think of buying options. So things started to change though. In 73 and then also in 77, we got calls first and then we got puts. And they started to become more popular. And again, think about how things used to be. I'm old enough to remember when cell phones were in a bag and you had to carry them around like this big purse. And they only worked in the really big city. And I'm from Kansas, so we don't have a lot of really big cities. And they had a battery that was like 5 pounds, and before that, Windows 98. And before that, the old computers, the old IBMs. Most people didn't have that stuff. They were still charting things by drawing them out. Imagine drawing out your charts, sitting down with a grid and a pen and a ruler and drawing out your charts and trying to calculate your moving average and figure out how big the wick should be and how much volume there was today. And then look at where we are nowadays, where we can see how much volume is coming in every second. And the markets are being recorded in hundreds of billions of a second. My mind can't even wrap my head around how many zeros that is, but hundreds of billions of a second, the market is being recorded. These trade values are coming in very, very fast. And how the Greeks are calculated and how much power it takes to calculate that, they're still working on it, which is why today, for an example, when the market spiked, a lot of options across the board all went up the exact same amount. It didn't matter if it was Bob's Tree Service or Caterpillar. They can't calculate every single Greek on every single option in every single product, and they'll blanket the whole thing. I know that might sound really odd right now, and eventually we'll get to what I mean by that. But even today, with the amount of power we have in the computing space, there's just too many strikes, too many products, too many things, too many variables, and they can't spread it out correctly across the board with the accuracy that you think that they can. So there's a lot taken for granted nowadays. You will not notice these subtle changes. I promise it'll take a long time. I've been doing this for a couple of years now, and things still sneak past me, and I catch it later. Like, oh, shoot, I didn't even see that. How long has that been there? A day, a week, a month? They don't have some governing body that gives us that information all the time. Although there are some resources which I will be sharing in the next week. And it's the OCC, the OIC. There are governing bodies out there that do a lot of work. And they've been around since the 70s and the 80s. And it has nothing to do with like communities, you know, like the Bullish Bears. There's no competition or any kind of stepping on each other's toes. Those places that we'll be looking at next week have been around forever, and they develop the tools that we use. They hire the nerds that go in and figure out new formulas like the Black-Scholes or the Birkin sand, you know, whatever these different formulas are. The research is nonstop. It's constant, and so are the changes. So be aware of that. When the market makes drastic changes, it's not the time to be jumping in, right? Like today, I was trying to get a trade in the QQQ. I really wanted to go long off of the bottom in an options trade. And the pricing was so broken that I couldn't get a fair price. And so I had to wait until the later part of the day. Heck, I'm still not in it now. I'm still sitting here with a resting order trying to get a fill. And it's moved so far that it looks like I need to go in and try to get a new spot. But the pricing is so out of whack that if you come in here and you try to get a trade, these values are not fair. They're not even remotely close to being fair. We want to start a trade where both sides have an equal advantage, right? That's fair. Maybe I win, maybe I lose. That's the way it goes. But I should have an equal chance against the other side. And if we don't have at least that starting point, then we're starting out in the hole. And I don't want to start out in the hole. All right. So I would rather sit out. I'd rather miss the trade than take a bad trade. And the volatility that we got today jacked the values around just enough that they're not fair values. And so it's hard to get a good trade today. We can get a trade. Don't get me wrong. There is liquidity in here. We can get filled, but we would be getting filled at a disadvantage. Now, if I was only buying a call or buying a put, that would be completely different. That's going to be based on the extrinsic values that are right now in that option, and it's not incorrectly priced, right? There's no such thing. If options get out of whack, even the tiniest amount, arbitrage will send it right back into place. So they're fairly priced individually. But when we're trying to build a spread of any kind, a debit, a credit, we've got a ballpark idea of what this trade is worth and where its break even should be. When we try to price that around in different strikes in different areas, in the money, at the money, out of the money, and every one of them is off or wrong or mispriced or unfairly priced, then we know that we just have to sit out. We just stand aside or put in the value that we think is fair and see if we eventually get filled, right? And that's the best that you can do. Otherwise, you start out in a position that's already handicapped. It takes a long time to get to the point where you notice these things, but they are something that you will get to notice eventually. Just keep in mind how much things have changed and how cement they are now. Like at expiration, that option really will be worth 100 shares. For a while, that wasn't true. You could get options that would cover 50 shares or 20 shares, or they had all these different things that they tried along the ways, different programs, and they tried all kinds of different stuff. And then they eventually phased it out and said, yeah, you know what, we didn't like it. And the model that we have now has stuck with us long enough. I don't think they're going to try to change it again. I say that, but eventually they might try to prove me wrong. So there are some cement things that haven't changed long enough that we basically just lean on it. And an option at expiration really is worth 100 shares of stock if it's in the money. That's a given. That's a solid. We know enough about theta that it can be calculated really accurate. That's a given. Delta values and the way that they're applied to the option, that's a real thing. That's a given. So there are some cement things that won't change, but it's come a long ways. And what I wanted to point out with this page right here is just when things don't price right and it freaks you out, just calm down a moment, look at the trade and realize it might be showing you something that is completely wrong. Yesterday, we were looking at the SPX, and I had a $5 trade built. Now, remember, if I build a trade $5 wide, the entire trade, win, lose, or draw, is only going to hold $500. Maybe some of that is debit and some of it is credit, but combined, the whole trade is $500. It cannot get bigger than that. And yet, yesterday in the afternoon, the $5 spread was showing 515, 525, 550. The pricing was so off in the afternoon coming into the close on an expiration day that the values in there were getting well above $500. So we know that that's not right, right? It can't get bigger than $500. And yet that's what the value was showing if I wanted to build the trade or take the trade. So these values that you see, these pricings on the bid, the ask, trying to split the difference between the bid and the ask and hit the mid, they're not always going to be real numbers. They're doing the best that they can, but in volatile times, in times of uncertainty or high excitement, these numbers can get all out of whack. And if you go in and market order into a trade, you could be getting into some really horrible stuff. For example, this right here, I'm risking $300 to make $200, ballpark figure. Now I can build a trade like this and I can offer it into the market to where I risk 50 and I can make 450. Now this should not fill because it's not a fair price to whoever buys it from me. It's not fair. They're getting screwed. And yet I've gone in and built trades like this and thrown it out there just to see if I can get filled, and I've gotten filled because somebody who didn't know what they were doing came in and bought options at market. And if I set the market, then they're buying mine without asking if it's fair. They're just buying whatever it shows up. And even us retailers, we get to set the market. Right now, this option is trading with almost $1 spread. If I tried to split the mid, say on and just buy a single option and not a spread, it would make it a little easier to understand. If I come in and just try to buy one option, I can set the mid in here. Well, I can set it at whatever I want. So if I set a better price than what's shown here, mine will become the new bid or the ask. So make sure that you don't just go in and buy market at whatever price you're looking at, because I call it lure fishing, throwing a lure out there and seeing if I can hook something. Sometimes I just sit there for 30 minutes waiting on a trade to get filled, building a bunch of junk and throwing it out there just to see if I can hook something. And it's not even about, am I long in the market? Am I short in the market? Do I think we're going up? I don't care. If I build something that skewed and somebody takes it, they can have it. Because I can immediately turn around and close it for 70% profit. Just like that. So options pricing, especially in volatile events, they can get really out of whack. As good as we are now, we're way beyond these old days with these old computers, but they still have a lot of room for improvement. Don't market order into stuff. Is there any questions on this page before I move on to the next one? All right. So when we were talking about liquidity, I built this page because of this liquidity. When it comes to SPY, or really, we say SPY all the time, but what I really mean is the S&P. When it comes to the S&P, that thing is more traded than anything else that exists. In 1982, the OCC had an average contract volume of 5,000 contracts a day. That was the entire options marketplace. 500,000 contracts in a day. In 2008, it was 30 million contracts in a day. The other day when I wrote this, the SPX, just the SPX, had 1.4 million contracts. SPY had 5 million contracts. Together, I mean, that's over 6 million contracts in a day. And it wasn't even that exciting of a day. It was kind of it was a Friday, I believe. It was kind of, like, okay. One of those days. It wasn't even super exciting. So if the entire marketplace is trading around 30 million contracts in a day, and over 6 million of that all came from SPY, it stands to reason that SPY is impactful in the marketplace, right? The S&P. But it's more than that. It's not just the liquidity. It's way more than that. Our volatility models that we use, the VIX, it's built off of S&P. So when the S&P moves up and down, or when the S&P gets traded a lot, when it has volatility, it ripples across all products. The VIX is literally nothing more than the 30-day SPY implied volatility. So if I come into SPY and I go around 30 days out, we're looking at a VIX at what, 18.5 or 17.5. We got to split the difference between these 2 days because we would want, near the 30-day. That's the VIX. We don't have to go look at the VIX to know that that's the VIX, but we can. A little up. It's a little up from that, right? But this VIX, that's the volatility of SPY. Well, they use this VIX to calculate a lot of options out there, especially in them little mom and pop no-name companies that has options but isn't very liquid. They'll apply that to those products like a cookie cutter, and they'll just say, well, the VIX is at X amount. We're going to move the options this much, and that's what the new options value is. So SPY drives everything. Then when we start getting into things like algorithmic trading and what the machines do, the machines run in arbitrage. So when SPY moves, or when the S&P moves, that basket of products, the 100 different companies that are in there, it will buy all of them, or it will sell all of them. So liquidity comes from the S&P. Liquidity is driven by the S&P. The more this thing moves, the more that everything else in its pricing model, options, are going to move. Averages are a little unusual to get used to, and it mainly comes from going and looking at them every day, because unfortunately, these implied volatility values, they're not charted somewhere. It drives me crazy that we can't see it, right? But if I wanted to ask the question, where were these May 10 options yesterday? Just this series, where was the implied volatility yesterday? No idea, because there's no chart for me to go look at to see what yesterday's values were. Where was it this morning? No idea. So if you're not constantly looking in here at what the number is now, and if you can't remember what it was yesterday or an hour ago, then this logic's going to kind of slip past you a little bit, but it slips past all of us. In my psychology classes, they recorded how many times somebody would look at their watch. So I'm sure you can kind of maybe think, have you wore a watch or looked at your phone to look at the time, and then 3 minutes later you looked at it again because you couldn't remember? If you can't remember what time it was 3 minutes ago, you think you're going to remember that number 3 minutes later? No. You can learn to remember the number, or just get sneaky and write the darn thing down like I do. Write it down in your scratch pad, or take a picture first thing in the morning to see what the values are, and then refer to that picture through the day to see how much we're changing. It sucks, but it's better than nothing, right? Because we can't chart these values inside the strikes, but you want to get used to looking at those values. Are they going up? Are they going down? It will help you kind of get a gauge on where the market makers think we're going. And the S&P drives everything. So understanding more about what's going on in the S&P, it's daily stock volume, daily options volume. The more understanding you'll have of what's going on in the rest of the market. Options are still growing. More people every day are coming in to trade these things. They're becoming more and more common, more normal, and more easy to trade. Even just the logic of learning how to trade options now compared to 50 years ago is amazing. I've only been trading since 2018. If I had started in 1988, there's no way in hell I would be profitable and successful in less than 3 years. No way. You had to know somebody just to get the right data back then, right? Let alone try to understand the Greeks and any of those values. They didn't have the content back then even organized in any way to make use of it like we can now. There is a website that I have saved here, the OCC, and this is pretty cool. It's a free website. You don't have to pay to join this place. You can, like, they do have that kind of stuff, but you don't have to buy anything to be here. The OCC records all kinds of stuff, and they have back testing and research and analysis and white papers and just all kinds of really cool things in here, including the daily options volume. And you can always go there and look at what it is today, what it was yesterday, what the average is, and they'll even break it down like once a quarter into what they think is institutional trading versus retail trading. They'll look at different sectors, just all kinds of really cool benchmarks. So there's that one. And we will be visiting these guys next week along with the other ones that I've got saved. But I wanted to make sure I got that one put out there. Anything else, any questions here before I jump over to the next page? I know that understanding what we're talking about here isn't going to come just because we talked about it, right? It's going to take a long time before this starts to get tied in with the other things that you're going to learn. So you may be hearing this and thinking, I don't get it. You will, right? You will. Everything is connected in the marketplace, and they all lead back to the S&P. That's basically what we're getting here. If you think of spokes on a wheel, right? Everything leads to the hub. Everything eventually comes back to the center. Well, in the center of everything is the S&P. So kind of a broad outline of what we just covered is that because of data flow now and things like YouTube where we can go and learn, places like Tastyworks and Tasty Trades who've made amazing content and done all kinds of research, what we have now is unprecedented, and it's never been like this in history. Even the fact that you can trade options now with no commissions. When I started, they were only $5 a piece, and then they went to $2.50, and now they're about $1.65 round trip. But you can go to Robinhood and maybe like Webull or Doe and pay no commissions at all. Maybe just the fees, right? Like 10 cents. There's never been a time like this. A lot of old school traders were talking about paying over $10 one way. So you would take a trade in options and your fees and commissions, were $25, $30. So people were not trading, today's trades trying to scalp 35 cents when they had those kind of commissions back then, right? They, let alone having the data to be able to see the charts to even know that it was a good time to get in, right? Like a V bottom low on a 5-minute chart with a VWAP. You weren't going to get that 10 years ago. You know, not, you could get it, right? Don't let me misspeak. You could have gotten it 10 years ago, but to get in and out of it, you would have paid more commissions than the trade was even worth, right? So day trading and scalping and small duration moves and small time frame trades are bigger now than ever before. And part of it is because of the commissions. And the more, quote, free it gets, the more of that kind of trading we're going to see. The fact that the queues now have 3 expirations in a week, that's going to drastically change our landscape in ways that we don't even know yet. The reason that the S&P was the first one to get 3 expirations in a week is because it was experimental. They didn't know if they wanted these things called weeklies. And when they were trying to name them, they were actually called quickies. And that's not my story, so I'm not going to get into it. But even the name of them was something that was tossed around and debated, and, you know, they haggled over it until they finally got the name weeklies. They started it in the S&Ps, and they said, well, let's just do it for a while and see what happens. They didn't know what was going to happen. They didn't know if they were going to like it. What happened is the trading firms started to come in and run strangles on these expected moves, these 5-day expected moves, which is why we can go in and use that weekly expected move indicator. And we will end up getting to that. But the reason that weekly expected move indicator was even built was because of the SPY, or the SPX, and it was because of the way those 3 expirations work. And when we get outside of these weekly expected moves, the algorithms kick in, the algos, and they sell into selling, or they buy into buying if we're breaking out of the top side. And things can get very, very out of control because of that. Well, now the queues can also be used for a hedge. So what they do is they go in and they buy SPY strangle options or sell SPY strangle options. And then they trade the S&P futures to get delta neutral. And the more it falls, the more they have to sell to get delta neutral. Or the more that it goes up, the more they have to buy to get delta neutral. Well, if you buy into buying and you're a big firm buying thousands and thousands of ES contracts, what do you think you're going to do? Push price higher. Well, if it's already outside of the expected move and going up, and you're buying more because it's going up, your buying is causing it to go up even more. And it causes a volatility loop, which thankfully ends at the end of the week because the trade is broken. It's done. It's, you know, the week is over. They get to try again next week. So when we start to make a 2 standard deviation move or a 3 standard deviation move outside of these expected moves, that's when things get really nasty. The fact that we didn't get outside of the box today is the reason we just kind of just shrugged and said, yeah, whatever. Today wasn't bad. We didn't even leave the expected move. Today wasn't bad. Today was nothing. We didn't even touch the edge. But now we're going to be looking at the queues the same way because they now have 3 expirations in a week. We don't know that the firms are going to start using them yet, but the assumption is that they're going to. We'll just have to wait and see, right? We don't know. They're so new. Questions on this one before I jump to the next one? All right, so this is where we start actually getting into the styles of trading. And most new traders gravitate to the options like they are some widget. This is the idea that I can buy a call and then I can sell that call later on and get rid of it. Just like buying a car and selling a car later on to get rid of it, buying a house, buying a rock, buying anything out there. I like to use the analogy of baseball cards or Pokemon cards, right? You buy a card, you sell a card. Some cards get more valuable than others. But those cards or cars or rocks or whatever it is, it's not with some focus on where we will be at expiration, right? And most people that are new to options look at options as a thing to trade. They don't care what the call represents. They don't care what it could be at expiration. They just care that, hey, it's worth $1 now, and I'm hoping to sell it for $2 later on. Or I'm buying a put now at this price, and I'm hoping to sell it later at this price. That's trading like a widget. And the reason it's so popular is because it's so profitable. There is no other options trade that you can do that will make you more money than buying a call or buying a put. That is the money maker out of any kind of options trade you could ever do. So, of course, it's really popular. Unfortunately, it also loses more than any other trade you could do. To kind of put it into context, the state lottery is a very popular thing, right? You go in, you buy a $1 scratch lottery ticket. Well, what do you think the win rate on that is? It's really low. Sure, a lot of people win 5 here, 10 there, 20 there, but they're not hitting the $1 million jackpot. That's exactly like buying a call and buying a put. You're going to win here and there, but the jackpot is going to be few and far between. Now, the difference, though, between buying a lottery ticket and buying a call and a put is we've got edge. We can wait to buy a call or just buy an option until we have indications of momentum or trend or something. And you can't get those in a lottery game, right? You go to the gas station, you can't hang out waiting for trend. So the analogy only gets us so far. But the reason that options pay so well is because they have a low expectation of winning. The market is a very fair and balanced place. And if you are in a trade that has a real high chance of winning, you're not going to see a lot of profit. And you shouldn't. You should not see a lot of profit, because if you're almost guaranteed to win, why would anybody pay you for that? You're not taking any risk. But if you're in a trade that has maybe a 50-50 chance of winning, then you should see some pretty good money out of that. And of course, if you're in something that has like a 10% chance of winning, if you do win, you should have a chance to make a lot of money. That's why people gravitate to the market, right? I want to take risk and make money. We have to take the risk or we cannot make money. That's just the name of it right there. Now, Susquehanna and a couple of the other really big firms, they're willing to trade for a fraction of a penny in profit. And they'll do that 1 billion times a day, and they make money doing it. But we're not them. We can't do that. So we need to take some form of risk to be able to make money. The more risk we take, the more opportunity for profit we should see. And buying calls and puts like they are something like a widget is what will pay you more than any other kind of trading out there. Now, this is my language, this widget talk. I've never heard it anywhere. I've never heard anybody else refer to it that way. So if you're thinking, man, I've never heard any of this crap before, that's because I'm the one that used that word. I'm not the only one who's ever said this concept, though. Unless I do say always or nevers or shoulds, then I'm not implying it either, right? So if we talk about trading a spread at the money, well, that's not the only way to do that, and that's not how we always want to do that. That's just one way to do that, right? And I don't say that I never buy calls or never buy puts, because I do. I just don't do it very often. I don't like to just buy a call or a put. I will. I don't like to day trade options either, but I will. I just don't do that as much as I do anything else. Don't get stuck in this logic that there is an always or that there is a never. Credit spreads are done 3 different ways. Debits are also done 3 different ways. You can choose any of the 3 or anything in the middle of those 3. So there's no right way to do one, no wrong way to do one, and there's no constant way other than what you choose. So when you do approach trading options, don't think that there is some really good answer for you when you think, should I be buying the call at the money? Should I buy the call in the money or out of the money? Which one of these is the right one to buy? Nobody can answer that for you except you, because the end of that sentence is, which one is the right one to buy for my bias, for my account size, for what I think the market's going to do today, for how long I want to hold this. Which one of these should I buy for me? You're the best person to answer that question. And in these classes, I'm going to show you how to figure out that question so that you know the right one to buy for you, what you want the market to do or what you think the market's going to do. But there is no right one or always one. So maybe this time it'll be in the money. Maybe next time it'll be out of the money or at the money. Questions on that before I move on? So if you do trade options like a widget, you're removing everything that makes options really, really amazing. Because with options, we can trade long, short, or sideways. But then we can also trade sideways long, sideways short, long and short, but not sideways. So that's 6 different ways that we can combine options to trade in the market. We can make money from any of those 6. But if you only buy a call or a put, you can't. You're basically just trading stock. You're in a binary choice of, it's going to go up or I'm going to lose. It's going to go down or I'm going to lose. Worse than that, it's going to go down by X amount or I'm going to lose. It's going to go down by X amount at this point in time or I'm going to lose. And then it becomes a lot more difficult. It is difficult to try to anticipate where the market will be 2 weeks from now at expiration. It's not because you're new that you might have lost a trade like that. It's because that's a difficult thing to do. Even experienced traders don't know where the market's going to be in 2 weeks at expiration. So if you only trade an option like a widget, you remove all of those extra choices and all you've got is long and short, and you better hope it goes far enough or you're not going to make money. You're not going to make very much money. So this is where we start talking about, well, Susquehanna and all the other big firms out there. How are they able to make money all the time? I think right now Susquehanna has a track record of like 8 years with never having a red day. Can you imagine that? No red day for 8 years. Yeah, I want to do what they're doing. What are they doing? Well, the subtle difference in there, I didn't say they never lose. I just said they've never had a red day. So if you trade small and you trade often and you run the probabilities, if the trade strategy that you're using has an 80% win rate and you trade it 1,000 times a day, you're going to average about 80% win rate. If you want a 90% win rate, then you can do that. If you want a 95% chance of winning, you can do that. But you have to have enough occurrences for it to actually be a thing. Because if you only trade it one single time, it can lose. If you only trade it 10 times, it can lose. One of the easiest analogies for that is to flip a quarter. If you flip a quarter, what's the chances that you're going to get a heads? It's a 50-50. What about when you flip it again? What's your chances of getting a heads? 50-50. Now, here's the mind screw. We know that eventually you're going to get a tails, but every time you flip it, it has a reset 50-50 chance of being heads. You could literally in theory, get heads forever because it's a 50-50 chance. Now, we know that if you flip it 10 times, you're likely to get something like a 60-40, maybe a 70-30. But if you flip that quarter 1,000 times, you're going to have about 50% heads and 50% tails, because it's a binary choice of yes or no, right or wrong, good or bad. That it's just a done deal. There's no other choices in the middle. When you build a spread that has an 85% chance of winning and you trade it 1,000 times, you will win about 85% of the time. Unfortunately, that's not good enough because it's a fair and balanced marketplace. So on the 15% that you lose, those losses will be big enough to wipe out all of your wins, and it becomes a zero-sum game. You're at the end of the year with no more money than you started. Worse, you're probably less because you paid commissions. So if you only take the trade because it has a probability of 85% and you're not stacking the odds in your favor, it's a zero-sum game and you're going to be not any more profitable than you are right now. You have to add edge. The edge that we add is by looking at the chart, by timing our trades, by managing them and getting out early. All of those things add edge. They're a way for us to beat the odds and get the number up even higher. So for an example, I build my put spreads with a 50% chance of winning, a binary 50-50 chance. That's where I build them. That's the pop that I aim for. And yet I have a plus 85% win rate. I increased my win rate over 30% with edge. So it can't just be the probabilities alone. When it comes to the firms, they're running at a very, very high rate, really, really fast. And they have no fees, no commissions, and that gives them edge. So that's part of it. The other side of it is they're not looking at the same things we're looking at. The trading firms don't go out and look at the candle chart. Anything that goes on a candle chart, they're not looking at it. So no indicator in the entire group, all of these 400 and something indicators, they wouldn't be looking at a single one of them. They don't care what the high, the low, the close. They don't care about the stochastics, the MACD, the RSI. They don't care. They don't care about momentum or trend or none of that. They're not looking. They don't care. And that's not what they're basing their trades on. They're basing it on something else. Now, when I say they, I'm not talking about all firms, because remember, there's no always and nevers. Not every single trading firm out there is like Sequoia or Susquehanna, right? They're not all doing exactly the same thing. And a lot of them are trying to be as sneaky as they can. So we don't know a lot of what they do all the time, but they publish research papers when they no longer use something. And that's how we learn more about what they are doing, because they'll come out and say, well, in the last decade, this is what we were doing. And the fact that they told you means they're not doing it anymore. They've already moved on and they're doing something else, right? Because they're not going to give us their edge and tell us what they're doing. But most of those firms are looking at a reason for a company to continue to go up, right? Their fundamentals, and then they're participating in a market. And they do it with their own edge, partially by not having the commissions, two, being big enough to just keep buying. That helps out a lot, right? There's always this discussion in the market that you cannot go against the market long enough, right? If you go long and the market goes down and you think, well, I'll just keep holding on. You can do that on a lot of things, but you can't do that in all things. And if it's something like the futures, it can go down and stay down a lot longer than you can hold on. So we can't hold on. And the funny thing is the banks and these big firms, even they have their limits. Back in February, of last year, when the market started to crash, gold went down. And a lot of newer traders was like, what the heck? I thought we are supposed to go to gold and utilities and silver when the market goes down. I thought that was a place to hide. There was no hiding back here. Everything went down, including gold and silver. And the reason the gold went down is because the banks were getting margin called. Those big trading firms were getting margin calls. They were told to pony up more capital if they wanted to keep their trade. They needed money, and so they went and sold their gold to generate capital. So, of course, if they sold gold, gold went down too. Everything went down back there. There was no safe place to hide. So even they have a problem holding on long enough if the draw gets deep enough. So trade with some kind of edge. Always be looking for it. Always be thinking about it. Always be on the hunt for some kind of edge, even if the edge is nothing more than closing the trade early. Believe it or not, that provides edge. It's the same edge that anybody else has access to, but a lot of traders won't close early. They want every single dollar out of that trade, and they'll hold it all the way to the close. It's not right or wrong. It's just what they do. Now, earlier in this chat, we were all talking about POP, P-O-P. And when you look at POP, and I did it, you will do it, everybody does it at some point, you have this belief that the probability of profit that you're looking at has something to do with the trade that you just built on the product that you're trying to trade on. And it does not have anything to do with your one trade in that one product that one time. What it is telling you is that if you built this spread at the money and you collected that much credit, you will have a probability of winning about 50% of the time if you did it 1,000 times. And if you go out of the money by X amount using this delta at that price on this product with this many days to expiration, and you did that 1,000 times, you're going to win about 54% of the time, or at least you'll have some form of profit at expiration, which is what that is calculating. But POP has nothing to do with you and your one single trade, one single time. And a lot of newer traders get lost in that logic right there. These are probability models that is looking at all of those key pieces: days to expiration, delta values, strike position in, at, or out of the money, and the product that you're in, right? And the volatility that it has, all of those metrics. So finding edge would be going long across the bottom, right? Or avoiding earnings, or so many ways that we can put some edge in our trade, which is why a lot of the strategies that I develop have those kind of words in the strategy right off the bat. Words that says no earnings, no gaps, no can't have this, can't have that. And those are just right up front. They're a part of the rules. And I tend to build the rules. I lost the Discord. There to go. I tend to build those rules in a way that help me stay consistent. Shoot, I lost the Discord. Where'd that darn thing go? All right, well, we'll use the other Discord. Yeah, I know that hurts everybody's eyeballs when I do that. Just kind of drag it out a little bit. Ah. do it that way. Thank goodness Discord is built into the side there, makes it so much easier. Rules like this, that I'll go in and name a strategy and start putting in very specific, very simple, common, easy to read rules like don't trade this strategy 30 days before earnings. Don't trade it if there's dividends. Don't trade it for this or that, whatever. And then where I'm getting in. Am I at support? Is it breaking out? Notice that this is an options trade with options rules, and yet my rules have nothing to do with options yet. It's talking about market conditions, what I don't want to see on a chart or what I do want to see on a chart, because I'm trying to give the trade some form of edge, right? Some way to increase that pop. So take the time to try to find that edge in your trades all the time, no matter what kind of trade it is, but especially in options. Any questions on that before I go on to the next one? I think this is the last page. Yep, this is the last page. All right, so I wanted to make sure we had a stopping spot, so I didn't continue to write on this thing, knowing that I wanted to wrap up and give you guys a time to just ask questions that are on your mind, whether it's something we covered today or not. So let me get through this last page and we can hit on those. If you're trading options, buying calls and buying puts, and you're only focused on the price of that option, you're losing track of everything else and you're stuck in a directional trade. Trading directionally is not what the firms do. It's why they win so much. I tend to trade more directionally in my futures trades than I do in stock and options because I have more opportunities in options to choose something else. So I'd rather not trade these directionally. Plus, they just don't pay as good as other products, even in a directional trade, like buying a call. I can make more money buying a futures contract than I can make buying a call, and I can do it with less risk. So I might as well just trade futures if I want to trade direction. And it's not about what's right or wrong. For me, it's about which product can make me more money. If you think about trading in the S&P, right? And we're not talking about SPY necessarily, just the S&P. If you're product indifferent, you can trade the SPX, the XSP, the SPY, and the ES, and the MES. You've got all of those choices if you want to trade the S&P. And every one of them offers you different kind of edge. It offers you different possibilities, different probabilities. You can do them in different kind of accounts. So if you're completely product indifferent and you just don't care what the product is, and you only focus on what suits your needs, you can have a ball in here and do all kinds of stuff. For an example, selling a put on SPY. Right now, put selling is a great way to make money. I love it. But if I wanted to sell a put in here, even in a margin account, I'm going to need $42,000 a margin. That's a lot of money. if I sell a put on the MES, I only need like $1,600 of margin. It's the same product. I'm going to go long in the S&P. I can do it selling SPY puts, or I can do it selling MES puts. It's the same thing, right? It's the S&P. One of them I can do with a lot less buying power. Now, of course, you know, there's a trade-off, right? There's always something. Everything is very fair and balanced. If I'm going to be able to take a trade with less buying power, I'm going to have to give something up. So there's always something being increased or decreased to make everything a fair and balanced market. But these choices or these opportunities means I don't care what it is out there. I can find a way to reduce my risk, increase my profit, find a trade that fits my account. And if I'm only focused on the S&P, I've got all of these choices to do that. That's being product indifferent. If you get out of the idea that you have to trade directionally, the sky is the limit on what you can trade and how you can trade it. So keep that in mind. And in these classes, we're going to get into all of that. This is just introduction day. And I'm going to be running 2 classes a week. One very basic and introductory like this, where we just talk nice and broad general terms. And then the other one where we get all nerded up and crawl down deep into the numbers, tactics and strategies, all that great stuff. So we're going to get into how these pricings come in and all of that. Just keep in mind, if you don't understand how or why that trade is making money, you're never going to be successful at it, right? Like mimicking somebody is a great way to learn the mechanics of something. Oh, I buy this one and I sell that one. I buy this one and I sell that one. Oh, that's how it's built. Yeah, that's a great way to form muscle memory, but it doesn't sink in on the why. Why would we build it this way and not that way? Why would we put it here and not there? Why this expiration and not that one? Why was it not a fair price? Right? Like we were talking in the Qs earlier today. Without the why behind it, you'll never grasp the options logic, and then you won't have all those choices available to you. So we'll be getting into those. Day traders and short-term traders, they just buy options because they believe that the move in the stock price is going to cover the loss from the Greeks, and that option that they bought is going to make them money. It's pure binary, right? Like the only choice here is win or lose, and by how much. And that's the only thing you got. But it doesn't have to be that way. So that's a wrap on the introduction, guys. And this would be the spot where, even if it's not something we talked about today, the door's open if you want to ask questions. Rick kind of beat you guys to the punch. So, Rick, I'm not buying anything on the MES other than MES contracts. I don't buy options on the MES. I will sell a put, and only a put on the MES. Only a put. And mainly that's because I'm a bullish, like a perma bull. I would much rather sell a put than sell a call. And that's just me. I don't want to sell a call. We could, but I don't want to. I'll sell a put because I'm bullish. Like today, I sold a couple puts. Now the market's closed. These puts aren't going to price correctly, but if I was to sell a put in here, look at the buying power effect. It's only $1,100. Now, if I was to try to sell a put on SPY, $8,252, right? So I could sell 5 of the other ones and still have buying power left over. I can only sell one of these, and I'm going to need $8,200 of buying power. Now, of course, the money is completely different, right? The profit in this, $330. The profit in the other one is like $30. But I can sell more of them, right? So max profit, $190. Most of the time it is, but not always. For me, most of the time it is. But there's no always, and maybe you weren't in here on that part, but when I'm talking about these, unless I specifically say I never do, then never's not a part of it, right? And always isn't a part of it. If you look at the market today, and remember, when we're selling something, we need the market to go opposite. So when I sell a put, I need the market to go up. At what point today would you have been comfortable selling a put in the market? And keep in mind, it doesn't have to move anywhere. It only has to not do something in the options market. So after we gave that double bottom today and we got a higher low, we could have come in here and sold anything below the low of the day with some high degree of confidence, right? That the market would not come back down below this low and that our trade would be successful. All we need to do to be successful is for that market to stay above our strike. That's all. It doesn't matter how far up. It doesn't matter if it goes to the moon or if it just stays right here for the rest of the time. As long as it doesn't come below our strike, we win. That's one of the reasons I like selling options, because I don't need the market to do a damn thing. It doesn't need to run, doesn't need to not run. It just needs to stay above my position. Or if I sell calls, stay below my position. But when you sell a call, which is why I don't think this through, when you sell a call, the market can literally go to the freaking moon, right? And we know that it won't, right? We know that the MES isn't going to go to 9,000 tomorrow. But we do know that the market can make extreme, drastic moves, and I'm a perma bull, so I believe those moves typically are more long than short. Oh, yeah, it can. Yeah, and that's exactly right. Plus, the buying power is different. The margin requirements from your broker are different because the broker says, well, eventually this would hit zero, right? If I sell a put and I'm wrong, how much could I theoretically lose? Well, we know where zero is. We know the S&P is never going to fall all the way to zero, but the calculation can be made. But when you're looking at selling a call, we don't know. There is no zero, right? Because in theory, the market could go up forever. And so the market makers, when they're trying to price your risk, look at something like this and say, gosh, I don't know what to tell you, right? And if they're worried, we should be worried. So I just don't like to sell calls, but we can look at the buying power for selling that call. It's only $1,200. I can afford that. I can cover that. But if we go to the SPY and I try to sell a call in here, this one would take $8,200 to sell a put. What about selling a call? $8,200. God bless margin, huh? So for $8,200, I could sell that call. I am not really comfortable with the idea of doing it, so I won't. And when it comes to selling a put on anything, if I'm completely product indifferent, I want to use the one with the least amount of buying power reduction. I'll sell puts in the MES. And I do it with the logic that I believe we're going to stay above X value. I can do it for the day, for the week, for the month, for the year. It doesn't matter what I choose. But since I sold it, more days won't give me more money. If this makes sense, right? If I only sell it for $500 and it's going to expire at the end of the day, the most I'm going to make is that $500. One day, 1 week, 1 month, 1 year. If I sell it for $500 and it's a year-long trade, I'm still only going to make $500 at the end of the year, if I'm right. So duration does not necessarily mean I'm going to make more money. whatever I sold it for, that's the max profit. I do tend to do these on a day-to-day basis. I want out by the end of the day. I don't want to hold them overnight. I don't want to swing them, but I have before. I will again. I like selling puts in the MES. I've been real excited about being able to do that because these micros gave us opportunities that we've never had before, right? Because I certainly wouldn't do that in the ES, but I'll do it in the MES. The Greeks, understanding their effects on the option that you're going to trade would be important from an understanding point of view. But when it comes to actually taking the trade, the Greeks aren't going to be your decision maker, right? It'll be based more on the price of the market. So for an example, when we're looking at the MES, where on this chart would you like to have sold a put? That would be your important decision. Where do you think price is going to stay above? That would be your important decision. It wouldn't be what delta do you want to sell or what's the level of implied volatility on that put. Because if you're going to sell it today, they're all going to be running at about the same volatility. Sure, the numbers are off a little bit from one strike to the next, but the volatility we had today is not the volatility that we had yesterday, right? And selling things with a higher vol is better than selling them with a lower vol. Still doesn't change the fact that if you was going to trade an option today, any of those in today's duration would be the one that you'd be focused on. And your decision on which one to sell wouldn't be based on those Greeks. It would be based on this chart price. It is surprising how straightforward options really are when we talk it through in plain English. It's the videos that get into using fancy language that screws everybody up, right? Options are not complicated if we can translate it into English, which is why I ended up doing these introductory videos. I've been asked to make these for 2 years, and I kept saying, no, why would I make an introductory video? There's thousands of them. But almost every single one of them that I went and looked at was approaching people with this concept that they already knew what the market looked like for options. Like they had already been trading for years and was just now going to start getting into options. And that doesn't even remotely fit the community that we're in here, right? It doesn't fit me. I got into options in the first month and a half of my trading life. My account was so small, I didn't have a choice. It was either, well, I'm either trading options or I'm trading penny stock. And that has a very, very low edge. I didn't have time to learn technical analysis, and I didn't have time to learn all the nuances of penny stocks, and I had a day job. So I needed a way to trade and make money with a small account with high leverage and something that had an end in sight. You can learn technical analysis every day for the next 50 years. And every morning you would wake up with something new to learn. But in options, there's a roof, like a plateau that you get to. I certainly do not know everything about options, but I know where to find information. So if I do run across something and I say, gosh, I don't know, that's really odd. I've never seen that before. I know where to look to try to find the answer, right? And sometimes just knowing where those resources are is better than nothing. And then I know more than most of the people I trade against. And that gives me a lot of edge, right? It always helps to be the smartest person in the room. So if I have to compete against other people that are trading options, I'd rather be the smarter person, right? I'd rather know more about how these options work than my competition, especially if they're going to use more money than me. Yeah, I try to be completely product indifferent. I don't care what it is. The Qs, there's multiple products to trade the Qs. Same with the S&P. It doesn't matter to me. How can I reduce my edge? How can I make money in here safer? And then spreading out the accounts too. You know, I love to day trade in the futures, and I do that in the NASDAQ. So I have to make sure that, you know, like I don't want to swing trade a futures product in the same account that I'm going to day trade the futures product, because then first in, first out is going to kick me out of my own trade. Product indifferent. Margin is a big deal. I don't trade with margin, but I have margin privileges, which is why I know what these pricings look like. And if you look at an option in futures, it's really, really confusing, because this would make you believe that there is $3,200 here, right? $3,250. And it's not. It's not that number at all. But if we go to SPY and we look at the price of an option, that's $564 right there. There's no doubt or confusion. We know exactly what this is, right? So it's not as simple and clean as it looks when you start getting into futures. So just be careful with that. What's nice, though, is that on this platform, I can see those numbers down here in the bottom. My max profit, $156. Buying power reduction, $1,063. There's no confusion there on what I'm dealing with. Thinkorswim, on the other hand, it's confusing. It doesn't show it to you like this. So, William, I plan on doing this every week. 2 classes a week, one advanced, one introductory, and each one will be built off of the previous week. If you miss a week, no problem. They're going to be archived. I don't know what that archive is going to look like yet. I have a meeting with Lucian tomorrow to bring in some new content, and we'll talk it over then to kind of see where this is going to go. But they will be recorded in their own spot. They're sequential. So, you know, next week we'll keep going from where we left off, and then the next week and the next week. Each week we're going to get into both. So for the complex one that you're talking about, that's coming. That's this week also. We'll be doing both, because I know that people are trading complex systems without understanding the basics of options, like intrinsic and extrinsic values. That's common welcome to options material. And I've had people tell me, oh yeah, I know calls and puts. And when I say, oh yeah, what's the extrinsic value on that? Oh, I don't know. I don't know what that means. So just because we're trading these things don't mean we know what they are or what the values are. So we're going to be doing both the complex and the introductory. One of the main takeaways from today is that no matter how you come into the options market, whether you want to be a day trader, a swing trader, a mix of both, because you know it's not binary, we can do both. No matter how we come into the marketplace, things are evolving around us. They are changing. There are some cement pillars that don't change. The data models can be trusted, right? Some of those key takeaways. Understanding that these things do represent stock is going to carry you a long ways, especially in spreads, right? We'll be getting into it later, but if you think about what it means to buy a put, just something as that, what's it mean when you buy a put? What did you buy? And yet when you put it into language like this, that's what you bought. You entered into a contract with someone and you said, hey, at expiration, I get the right to sell this stock. Maybe you're not going to sell it to the person that you're talking with. Maybe you're just going to sell it to the marketplace, but it's your right. Now we're going to get into that next week of actually understanding what it is when we go in and we buy a call or we sell a call, buy a put, sell a put. What the heck is it? What does it mean? And once we know what that means, things start to make more sense when we start getting into a spread. You know, if I come in here and I buy this 414, I get the opportunity to sell stock at 414. No matter how far we fall, I can make someone buy it from me at 414 at expiration. Even if SPY is only worth $100, they got to pay me $414 a share for 100 shares. That's what I bought when I buy a put. The right to sell stock at expiration for 414. Even if I don't give a damn about expiration and I only want to buy it for an hour, it's still what it represents. So back in the day, not even back in the day, hell, I've done this recently. If you know what you want to buy a stock for, say you're looking at the stock and you're thinking, you know, $415 for SPY seems a little expensive. I think I would rather buy SPY at $410. You can just go in there and sell a put at 410. And eventually, say later on this week, SPY finally falls below the 410. You get assigned, you get to buy that stock at 410. That's what you wanted. You wanted to buy it at 410. You just didn't want to miss out on the trade, because what if you wanted it at 410 and we don't go there this week? So you sat out waiting, thinking, man, I really want to buy some SPY this week. I'm going to buy it at 410. It never gets to 410. You never get your stock. You wasted your week. You didn't make any money. Now, if you sell a put there and we don't actually get to 410, the money that you got from selling the put, that's all yours. You get to keep it. Sure, you didn't get your stock, but you can try again next week. At least you got paid for your time while you were waiting. You made money waiting for stock to come down to a price that you thought was acceptable so that you could buy it at that price. Hey, that's a good way of doing business. If you own stock and you think, you know, I'd sure love to get rid of SPY at 420. Well, you could put a stop up there and say, you could put a buy limit stop order. And when we get to 420, maybe it'll sell you out. Maybe not, right? We could be closed and then, you know, maybe your order doesn't get filled. A lot of different reasons you wouldn't get filled. Or you could sell a call. You just sell a call at the 420. And every week that we don't get to 420, you just get to keep that money. Eventually, SPY finally gets to 420 and you lose that stock that you've been trying to get rid of at 420. You still made all the money in the meantime, and you got rid of your stock at a better price than you bought it. There's so many great things about trading options. We can use it to acquire stock. We can use it to get rid of stock after we've acquired it. We can own stock for like dividends. I know somebody who has AT&T stock. He said that his wife worked there and they have a lot of AT&T stock, right? They just got it because they worked there and it was a part of the employee package. And, you know, they've retired now. They've had a lifetime of service and they have a lot of AT&T. That might sound great from the perspective that, like, well, you got a lot of stock. That's freaking awesome. Yeah, but have you seen AT&T lately? It's not like that thing is growing year after year, making you a crap ton of money. So what are you supposed to do with it? Well, the good thing is it's a dividend king. This thing pays you a dividend just for owning stock, right? So if you own a couple of million shares, that's exaggerated, but you own a lot of stock in here, they're going to pay you for owning that stock. Well, what else are you supposed to do with it? Just like the deed to your house or the deed to your car, you can use it for leverage. So you could use the buying power that a million shares of AT&T would give you, and you can trade off of it. Or you can also go in and sell options against it. Now, nobody wants to lose their options, right? So you don't want to go in there and do risky stuff. But if you sold calls against stock that you own with no intention of ever getting rid of the stock, every week that you sold those calls, or every month, every year, whatever, as long as we stay underneath that price, what you sold it for, that's the credit you keep. And it's still paying you a dividend. Their dividend right now is 52 cents a share. So for every 2 shares that you own, they'll pay you $1. If you've got a couple of 100,000 shares in there, sure, it's not going to, pay for a trip to Vegas, but that's a good dividend to own. It's a good dividend stock to own, but as a stock, the damn thing's not very impressive. I wouldn't want to allocate a lot of money into AT&T stock and then not have any money to trade with. At the very least, I can sell calls. I can make money from the dividend and make money from selling calls. Both, right? And when they do pay me dividend, I can go in here and sell puts until we finally fall back down to these lows. And those puts end up getting assigned, and I get more stock at these lows. And if we don't fall to those lows, I just keep selling the put and keep making money on those while I'm also selling the calls up here. Options are so awesome. I love it. I'm long in all kinds of stuff right now. And when the market went down today, I made a lot of money. I'm long in Boeing, Walgreens, Starbucks, Apple, Carnival Cruise Lines. I'm all over the place. I've got option calls all over. And because I bought a call, I also have short calls all over the place. Take this Coke trade for an example. I'm long in Coke. So I went out there and I bought a January call in Coke. Sometime between now and January, I expect Coke to go up, hopefully higher than 57.50. Along the way, as long as we stay underneath Coke, 57.50, this one that I sold is going to make me money. And I'm going to keep selling those calls and closing them and selling another one and closing them and selling another one and closing them until I have paid for this long call. And now I'm just holding a long call for free. It's already paid off. I covered all the risk. There's nothing that I can lose at that point. And I can just carry that long call for free. You got to love free. No risk. Opportunity to make more money even while I'm sitting in a trade that's losing. Heck yeah. Sign me up. I want more of that. So today was just the introduction, kind of talking around the background of them. Realizing that the pricing that we see in here is not, it's not handed down as accurately as stock price. So when you're looking at options and these values are all over the place and it's showing you some price in here that's absolutely insane, it's insane. It's probably not right. Use limit orders as much as possible. Look up and down the chain. Look at the bid-ask spread. Don't just come in here and pay whatever it is that they ask for. That's crazy. You're going to get someone like me sell you the London Bridge, right? You don't want to do that. You'd be surprised how many of them lures I get orders filled on that I wasn't even trying to get. I didn't think it would really fill. I just put the order in some crazy price. Any other questions, guys, before I kill this stream? The only problem with running multiple streams is something like that. I lose products sometimes. I got a Discord floating around somewhere. I'll find it later. It is being recorded. They will all be recorded. They'll all end up in the Bullish Bears. I just don't know where yet. I don't think they're going to be in the archive with the regular streams. They might. I just don't know. I'm going to find out tomorrow when I talk with Lucian. I'm hoping that it's going to be that way, Corey. I am. I'm hoping. I can't say 100% though yet because I don't know where the other class is going to be. But Tuesdays are my days off, so I'm kind of more flexible on that day. That's why I chose today for the intro. It's the other one that I'm a little worried about, and it might end up being like on a Saturday if I have to. I really don't want to give up my weekends any more than I think you guys don't want to give up your weekends either. But hopefully we can get the other class inside the week. And if not, it's going to be Saturday or maybe Sunday. It seems to work out good for Tim. You know, he's real consistent about nailing that weekend, even though sometimes it's Saturday, sometimes it's Sunday. So maybe it'll be like that. Tuesdays are my days off, so this day is good. It's the other one that I'm kind of worried about. I think you guys will find, though, when it comes to options, the more you understand the background of it, the introduction stuff, the more a lot of the complex stuff starts to make sense. Intrinsic and extrinsic values, exercise and assignment. And then when we start getting into the model, like how options make and lose money, what drives the value of an option price higher and lower, that's going to help out a lot. Now, I've done 2 videos on using this Analyze tab, and it is worth watching as many videos on this thing as you can. TD Ameritrade, I think they've got 3 or 4 really good videos on how to use this thing, and I did 2 videos. One's on the Bullish Bears Next Level Library, and the other one is on the Bullish Bears free YouTube page. When you can stick a trade in here and analyze it and understand what's going to happen in the future, if that helps out a lot, because we got a pretty good idea of what a market can do, right? It can go up, it can go down, it can go sideways. So when we take a trade, whether we're just buying a call or a put, or if we're coming in here and doing something really complex, or even just doing a vertical, if we can take that trade and throw it over here and evaluate it with a what if, we start to get these really good ideas of what's going to happen to my trade. So here's a vertical. What if price goes down? I can move price on here and see what it will do to my trade. What if price goes up? I can move price on here and see what it'll do. I can move the volatility, make it go down, make it go up. I can move the time. So I can go forward into the future and see what would this thing be worth at the end of May? What if time goes by and we go all the way to the end of May? What will happen to my trade at that point? What's it worth? And say we only moved $4. We're at 415.47. So what if we're at the end of the month and we're at 419.57? What would my trade be worth at that point? Well, we don't have to guess or assume. We can move the model and look exactly what the trade would be worth. 419.48 at the end of May, this trade would have made $11.82 by the end of that day if the volatility stayed the same. And we can move that volatility as well. Today, the volatility went up, so we could subtract, say, a half of 1 point, and we can see what would the trade be worth if we lost some volatility and time went by and price went up. Now I can see the value of this trade, $12.41 at the end of that day, May 28th. So when you learn how to move this model around, you can ask what if questions until you're completely satisfied with the trade that you're going to take. And when you learn to do this, it opens up so many new doors, because we are all curious critters in our own way. And we learn by looking at things differently. Some people need to hear it. Some need to see it. Some need to put their hands on it. So when you can go in here and play around with the model, you can ask all those questions in a way that suits you and find your own answers. And it's amazing. So get more familiar with this Analyze tab. And we will get into doing trades in here. We'll come in and build complex things and analyze them and break them down, find out where they get their value from, ask the what if questions. We will be getting into that. If you get a leg up on your own and get ahead of me by doing that stuff, it will help out a lot. Because at the end of the day, we need to know, how is this trade supposed to make money? Where is the break even? What is my ask? What do I need to be profitable in this trade, whatever the trade happens to be? And when we can figure out the answers to that question, everything changes. And I look at people's trades a lot. I get emails, I get, the private messages, and someone will say, this is my trade and I don't know why I lost money. What happened? And they had everything right. The right direction, the right strikes when they opened the trade, everything was good. And they didn't close it when it had a chance, or they closed it too soon before it ever had a chance. They didn't understand the pricing behind the trade that they were taking. And of course, some people they go the wrong direction, right? They thought they were going up and they actually went down, or, those kind of mistakes happen. But a lot of options trading is probabilities. So it's not about, do I think the market is going to go up from here? Do I think the market's going to go down from here? It's, what's more likely, that we go up from here or that we go down from here? Well, that's a heck of a lot better question, right? Who cares what I think? What's the market telling me? We got a 70% chance of going up and a 30% chance of going down. All right, well, then I guess I'll go long, right? Because that's where the probabilities are. So being able to recognize how much requirement we need from the market to be profitable is kind of the defining characteristic of a trade being profitable or not. I see people buy a trade like a call, 1 day to expiration, way out here, and then say, I don't understand why my trade lost. We moved up $3 and I held it until expiration, right? But this trade has like no chance in hell of being profitable. And the market told us that it has no chance in hell of being profitable. All we had to do is look at the Greeks. It has a delta of 3. Now, if I'm buying this call, that means I have a 97% chance that this call is going to lose at expiration. And this 403 call way up here has a 100% chance of being in the money at expiration. Now, that number can change, but 100 sounds pretty good. If I'm listening to the weatherman and he tells me I have a 10% chance of rain, that's a bad analogy because weathermen are wrong a lot, but 10% chance doesn't get me real excited. I probably won't carry the umbrella. But if that weatherman tells me he have a 100% chance of rain, I'm probably going to carry the umbrella. All right, guys, unless there's any more questions, I'm going to kill this. I don't want the streams to get too long. And if you go back and are going to listen to the replays, you know, we want to try to keep them as short as we can. So maybe next time I will kill the stream after we get through the document and the questions, and then we can chit chat without it being recorded so it doesn't make the streams too long. But your guys' questions, I think, are going to be a good thing. And I don't want to cut the questions out. We just got to find a happy medium where I can kill it. That way the streams don't get, 4-hour streams. Nobody wants to sit through that. All right. No other questions. That's it, guys.